Our next guest does think it's unlikely the Fed cuts rates this year. Remains positive on equities, though, favoring information technology, communication services, consumer discretionary, industrials, financials. Oppenheimer, we were just talking about them. Asset Management Chief Investment Strategist John Stoltzfus here with a target of 5,500. Happy Friday, John. Good to have you back.
Same to you, Carl. Good to be here.
What do you think prevents the Fed from cutting?
I think it's just the stickiness of inflation and a concern by Jerome Powell that he doesn't want to cut rates and then have to go back and raise them again. I think the big thing is, the Fed has now, since March of 22, has raised rates 11 times, paused 8 times without a recession. That's really quite an accomplishment. It's helped, of course, by the resilience in labor and other things, and in business and in job growth. But at the same time, the Fed, we believe, has done a really good job, and they don't want to ruin it.
Would you agree that the market is trying to call his bluff?
Oh, you bet. The market represents many different constituencies, and in particular, the highly leveraged crowd has been really hurt by the higher rates. You go from a band of 0 to 0.25 to 5.25 to 5.5% on the benchmark rate. That creates the VIG is a lot more costly, carry cost. It's all problematic, and so when we look at that, that's an argument that occurs. But overall, it's not a bad situation when bond issuers have to pay for the privilege of borrowing money, and people, when they build their models, have to think a little more responsibly than they may have when money was for free.
We're at your S&P price target. So how are you feeling? Do you feel like there's a need to push that higher at this point?
Melissa, I think we certainly, once the market closes at 5,500 or above that on any given day, that's when we'll review it. And it would seem now that we are still very much in a bull market that is supported both by fundamentals on a cyclical basis, as well as secular growth stories that are impacting this. The other side of this is, too, I think the general population today is more concerned with retirement planning in realization that Social Security might not be anywhere near what it is meant for people. So whether a younger generation is planning for retirement years and years ahead, people who just have retirement a few years ahead, or those who are in retirement who want to retain their standard of living for a lifetime that might be a lot longer than they ever expected. Equities is a solution. Past performance, no guarantee of future results.
Yeah, although I guess the question is if, in fact, you have a greater propensity of people to buy more stocks, hold more stocks, or keep their exposures high, I mean, is there no cost on the back end in terms of return, right? I mean, that's the issue. You're paying today's price.
Yep, you're paying today's price. For people who were in earlier, for instance, if they add more, it increases their cost basis somewhat. But for those who are new to it, of course, the cost basis is going to be higher going in. But that said, AI innovation, other innovation that is in what we would call the proxies of AI, the other sectors that will benefit with greater efficiencies, hopefully from AI, would give us prospects for improved productivity, improved efficiencies in terms of all kinds of delivery of products and services that may take us to a really fairly good position going ahead.
Some of the sectors you like would ostensibly benefit from a rate cut, right? Why do you still like them in light of your Fed view?
They haven't done so badly in consideration of the Fed view. The Fed has remarkably, only of the ones that we like, only consumer discretionary has really lagged. And then within consumer discretionary, if we just look at first quarter earnings season that just ended, there were a lot of consumer discretionary stocks that did very well, even though many of their peers did not. It was a question of management, and how they and what type of products they had.
But do you think industrials hold up even if the market comes to realist view about cuts?
I think the market has come much closer to being realistic views about cuts. Remember, at the beginning of this year, we were in the camp of, we thought that the Fed would probably cut rates only twice. The general market was looking 3 to 5, and there were I even heard somebody say 5 to 11 because they thought we were going into a recession. we look at it and we think, this is manageable. If you go back all the way 500 years to the Venetians, that's when they discovered that a 10-year yield should be, whether it was sheep or cattle or coffee or pepper, the VIG was around somewhere between 3.5% to 4.5%, and people survived it.
Although, I was just going to say, in terms of if you take the Fed on its word, based on its framework, where it thinks inflation's going, the fact that we've had a yield curve inverted for 2 years, it seems like they are looking for the opportunity to what they call normalize, even if inflation's not at the target yet.
Oh, they sure are, Mike, very much so. And if anything, we think that if they do give us a cut in November after the election or in December or both times, it'll be effectively sort of like a down payment for both Main Street and Wall Street to say, cuts are coming, don't get too excited now. But, we're not going to be living at this band of 5.25 to 5.5. Maybe it'll look like, 5 to 5.25. What have you, but we're really normalizing after almost 15 years of most of that period in that band of 0 to 0.25.